Hi, everyone, and welcome to today's Green Quarantine session. It is Thursday, we're in September, and mostly I apologize. We had music playing, but I experimented with my putting in an earbud today, so I was the only one who got to enjoy Money Makes the World Go Round. And I apologize, nobody else got to enjoy Joel Grey here this afternoon. But it's okay because we are in for a treat today. Beyond my musical errors, is we have Charles de Segundo, the founder of Impact Delta, here to share an incredible amount of knowledge with us, all about how to use your investments to take climate knowledge. To take climate action. And I have been looking forward to this session for a long time, as I had the honor of meeting Charles this summer when we were in the same cohort of our Climate Reality Leadership Training. For those who don't know the Climate Reality Leadership Program, it is an organization that was founded by former Vice President Al Gore. And these trainings are free and available to anyone who wishes to attend. You can apply to become a climate reality leader. And so they are now virtual and online. Charles and I were in the very first global class where tens of thousands of us were trained this summer. And so I am excited to welcome him here today. And without further ado, I am going to turn the floor over to Charles. So Charles, if you want to turn your video on, and I know you have an incredible slide deck to share with us, and share your screen. And thank you so much for joining us here this afternoon.
Thanks so much. And thanks, Molly, for the kind introduction. And thank you all for joining. I've also been looking forward to doing this for quite a long time because it's an audience I don't normally get in front of. So thank you for having me. This is the screen that I want to share. Wait a second. It's not letting me move my material. Here we go. Okay, good. All right, here we go. So this is so my name, like when I said, my name is Charles de Segundo. I am the founder of a specialist sustainability advisory firm that advises investment management firms on their sustainability efforts and their ESG efforts more broadly. So ESG stands for environmental, social, and governance factors, which is something which is increasingly front of mind for people in the investment business, and also clearly sustainability is something that we're all paying more attention to more generally. So here's the plan. It's in 6 pieces. So it's about me and about your investments. That will get your attention, hopefully, a little bit. What's sustainable investing? What's impact investing? How do you think about performance, which is obviously important when you're investing? Who's getting into the space? Some examples, and then what you can actually do. So I'm going to move pretty quickly. And then as you have questions, obviously feel free to fire them over to Molly in the chat. We can address them at the end. I'd like to leave plenty of time for questions at the end. But here's the big idea. Investments have power. They have impact beyond financial return. This is kind of the key idea. And prices of goods in the world, and also of your investments, don't capture everything. By no means do they capture everything, and for a long time people basically just ignored the environmental impact of the products that they were buying. Now that's obviously changing. I'd say it's not changing fast enough, but the critical big picture point that you all should take away is the investment industry, like us as consumers, is cottoning on to the fact that they need to figure out how to kind of price in or kind of bring into their consideration environmental factors and social factors and governance factors, which up until recently were thought of as, in quotes, non-financial. That's sort of the big idea, and I put big air quotes around that because people are also realizing that if you do a good job on ESG, you generally perform better as well. So this has been a pretty big change in the last couple of years. We'll see some data to underscore that. But again, the point here is it's about you, it's about your investments, and it's about the things that you can do as investors. You may not think of yourselves as investors, but you save in your pension, you save potentially outside your pension, and so whether you like it or not, you are contributing as sort of participants in the capital markets. Okay, last point on this page is I really would love to hear your feedback too. So as I go through, there are things that don't make sense or things that particularly stood out to you, make a note and share them with me at the end, or my emails at the end of the presentation, share them with me offline too. So I'm you know, humans don't learn very well without feedback, so I'd love to get your thoughts. Okay, so about me, so whether or not a speaker is effective basically depends on three things. Are they knowledgeable? Can you trust them? And are they similar to me? I think this Aristotle kind of came up with the same framework of logos, ethos, and pathos. And the answer is I don't really know, hence the question marks. But in terms of knowledgeable, I have founded a sustainable sort of an advisory firm that focuses on advising investment management firms on sustainability. There's some other things about my resume which are potentially relevant on the slide. Conflicts of interest on point 2 are really important. You know, they are everywhere in the financial markets. Usually the people who are selling you things are also making money from selling you things. So it's really important to disclose those conflicts. And here, I'm happy to say there are no conflicts. I'm not trying to sell you anything at all. I'm just here to sort of share a little bit about what I know and hopefully sort of spur you to greater action. That's all I'm here for. And then are we similar? I don't know, in the sense that we are all investors. We're similar. We all care about the planet. And I suspect that we are all from what's called a weird background, which is something that the psychologists noticed, which is 80% of psychology research is based on Western educated people and who come from industrialized, rich, democratic countries. Now they are by no means representative of all the people on the planet. In fact, 80% or sorry, 12% of the people fit that description. The other 88% of people don't. And there may well be people on this call who don't fit that description. All I'm saying, I think, here is that we do come at these questions with a very particular point of view. The chances are we probably share that background, but it is really important also to understand that a lot of people on the planet don't necessarily, and that can make some of these solutions quite a bit more complicated. Okay, so let's dig into your investments. This is something I found online. I actually had a hard time finding more current information. I just Googled, I don't even know how to pronounce this. Is it IATSE? Can someone give me a thumbs up? Did I say that right? Okay. The annuity program that MassMutual was running back in 2009. And you have probably seen these at some point in your life. You have a whole bunch of investments which you can choose from, or you can pick a custom portfolio which brings these together in a particular way. The point here is that you actually have some influence about what is on that menu. You don't necessarily have to take that menu as given. You can, ask IATSE to make some changes. So that's sort of, if you wanted to think about action you can take, that's worth writing down. And the other thing I just point out here is that I'm glad to see that PIMCO, my former employer, actually ran some money for you, and hence the red box. Okay, here is the defined benefit pension plan. So the first screen you saw was the annuity. I found this online. This is more recent data. This is through the beginning of January 2018. And I'm glad to report that your defined benefit pension plan, which is where you know exactly how much money you're going to get, it seems to be in pretty good shape. You've got liabilities of right around 500 million bucks and an asset value of 483. So you're 97% funded, which is pretty good by most pension plan standards. So no particular worries there. I also looked at what you're invested in. So this is 2019, I think was the date of the document. You were 37% stocks, 14% in high grade debt, 15% in real estate, and then over 30% in other, but it didn't say what other was. So I think that may be private equity. We'll see, or sort of broadly alternatives. But there are different things you can do to sort of influence what's in that too. I can't unfortunately tell you because I couldn't get the information, but that is definitely worth digging into. Okay. So it's not letting me go down. Here we go. All right, so that's about me, and that's about your investments. So we're on to topic 2 already. So what is sustainable investing? What is impact investing? You know, the definitions kind of map onto what the words mean. So broadly speaking, sustainable investing is an investment approach that considers environmental, social, and corporate governance criteria to not only generate competitive financial returns, but also positive impact in society. So ESG is a phrase that you'll hear a lot. E is environmental. That's things like climate change, water use, pollution, all that sort of jazz. S is social. That's around labor relations. You know, do you run a factory where people go on strike the whole time? You know, do you respect human rights? What's your record on sort of anti-bias and diversity? And G is around how well do you run your company? Do you have sort of accounting scandals or ridiculous executive pay, that kind of stuff? Another thing that you often hear is socially responsible investing. Now that's often what's associated with what's known as negative screens. So that basically means I don't want to invest in casinos or people who make guns or cigarette manufacturers, that kind of stuff. And then the fourth phrase, which you often hear, is impact investing. And that is almost like sustainable investing on steroids. So that's where there is a very deliberate intention to create a positive impact. Sometimes you're trying to get a market return, and sometimes it's okay for the investor to earn a return which is a little bit lower than what you could get for the same amount of risk that you take. So those are sort of 4 terms to be aware of. And even though those definitions are a little bit fluid, they are becoming kind of, you know, more and more concrete as these investment spaces mature. And I quite like the framework on the left, which is from the Impact Management Project, which has this ABC framework, which you can see in the middle of the page. You can see my cursor here: act to avoid harm, benefit stakeholders, and C, contribute to solutions. So ESG is generally the stuff here in the kind of in the, you know, the A and the B, and then the sort of dark blue circle here, which is we're tackling a very specific problem, like in this case, sort of malnutrition in Africa, or you know, the education gap in, you know, between sort of different socioeconomic groups inside a particular country. And you can see, you know, A and B are just a little bit sort of less strong. Morgan Stanley, which is an entity I'm guessing you guys have probably heard of, have started offering products to their clients. They're sort of, you know, people like you and me who are kind of retail investors. And you can see kind of the sort of how, you know, there's sort of some alignment basically between the Impact Management Project and between Morgan Stanley. So that's that. Okay, so is it actually big? I mean, are people, you know, is this worth even talking about? And the answer is yes, it's big and it's growing. So globally, the sustainable investing market went past the 30 trillion mark in 2018. This is a survey that gets done every 2 years. And the good news is that in the US, 1 out of every $4 now under professional management, so people who've invested in mutual funds or ETFs, that kind of thing, is, as they put it, involved in sustainable investing. So that is not a very high bar, by the way. That is, you know, the investment manager just has some sort of ESG policy. They are kind of generally trying to not do harm. They're sort of more in the A framework and the ABCs that you just saw, but it's better than nothing. And I'd also say, you know what, 1 out of 4 is encouraging, but I think, you know, frankly, we really need to be in a world where 1 out of every $1 under professional management hits that bar. Okay, you should be aware of these too. This is the United Nations Sustainable Development Goals. You may have seen these in other things you do or other things that you've read. I won't spend a ton of time on them, but it's something that you see referred to a lot in the sustainable investing space for obvious reasons, because you know, these are all goals that, you know, broadly speaking, we all should be aiming for. Okay, now we are miles and miles away from where we need to be, by the way, on sustainable development goals. Just here on the left-hand side of the page, you see you have nearly 1 billion people facing really urgent challenges every single day. I mean, the one that really kind of gets people's attention is you've got nearly 700 million people who really don't have access to a toilet, and really, that sort of I think sort of starts to impact a little bit on kind of human dignity. And then down here at the bottom, 387 million children, or nearly half of children of primary school age can't read, which is also pretty tragic. The number here, 2.5 trillion, is a colossal number. And this is the number that has to be invested every year. This is not a sort of, cumulative number. This is a every single year number to hit these SDGs at the end of the decade. And obviously to do that, private capital, so the money that you and I save in our pensions or elsewhere, is a very, very important part of that puzzle. So overall, this is what we tell our clients. We see enormous potential for private markets investors to have an impact beyond financial returns, so that's social and environmental impact. And we also see enormous potential for existing firms to launch businesses that are attractive in their own right. Now, this is really important because you and I will not have attractive things to invest in from a sort of returns point of view and from a kind of sort of environmental impact point of view, unless it's also a good thing for an investment company to launch a fund which offers those benefits. So you kind of need people to care about it, and you also need it to make sense for the investment industry to offer products, or offer funds that sort of tick those boxes. So the place where everybody begins in investing is, well, what about performance? Does ESG affect performance? Is there some sort of give up in performance that's associated with trying to do the right thing? And the answer is, we basically think it's the opposite is true. We think that ESG is a good thing for performance. So there is no conflict, there's no trade-off on that front. So here's what I did. I looked at a bunch of different things. I tried to find the best data I could. This is across asset classes. So this is, this is timber, real estate, and infrastructure. These are three, important, but, by no means the only asset classes. And this is pure impact investing. So this is the C, this is the dark blue circle here. And what was the effect? If you got people who were trying to focus on a very specific problem, did they give up a lot of return relative to the universe? And the answer is basically no. I mean, timber, the median fund actually outperformed. Real estate, it underperformed, but there was a sort of narrower distribution of outcomes. Infrastructure, it outperformed the PE energy benchmark, but it underperformed the traditional infrastructure benchmark. So, it's just sort of, I would say, broadly in line. And this, by the way, is for people that are really, really focused on sort of a very specific problem. This is not sort of the broader sustainable investing markets. Now, what about geographies? Is life different in North America versus developed Europe versus Asia, Australia, New Zealand / developed Asia or in emerging markets? This is an amazing study, and they looked at 2,000 earlier studies dating all the way back to 1982, and they basically asked themselves, did the study find a connection between ESG and corporate financial performance? And they looked at E by itself, and they looked at S by itself, and they looked at G by itself, and they looked at them all together, and they looked at different asset classes, equities, bonds, real estate, or across the whole portfolio, and they looked across geographies. And the punchline is, you can see across these 2,000 studies, 63% of the studies found a positive relationship and 8% found a negative relationship. And I say relationship because it's difficult to say with a lot of confidence that it necessarily causes better financial performance in every case. But in some respects, maybe that doesn't even matter whether you're dealing with correlation or with causation. The point is, if the company has good ESG practices, it appears most of the time to result in better financial performance, at least according to 2,000 prior academic studies. All right, what about different data sets? So this is what I see here. This is what you see here, rather. So this is work from Bank of America in 2018. And what they did is they basically said, well, not everybody measures ESG in exactly the same way. Sustainalytics is one data provider, which you see here, the yellow. The green is Refinitiv, the orange is MSCI. These are all well-known providers of ESG related data, and they often don't agree with each other particularly well. But Bank of America said, well, let's just split companies up in each case into the sort of top quintile and compare it to the broader market and see if they outperform. And they, in every case, the Sustainalytics case, the Refinitiv case, and the MSCI case, they did outperform. Now, there's another big one here, which is this concept of ESG blunders. And I think you guys hopefully can see my my cursor. I can't see you guys anymore for some reason. Here we go. Can you give me a thumbs up if you can see my cursor on the screen? Yeah, okay. So so this one over here, where it says ESG blunders, is basically kind of just big missteps where a company just screwed up in a massive way. Boeing and the 737 MAX is a great example. Going back a few years, BP with Deepwater Horizon, going back a few years also. WeWork. I mean, these are just sort of examples of companies, just doing, unethical, bad things. And that clobbers the share price, as you can imagine. Bank of America pointed to the sort of 500 billion of market value that was wiped out between 2014 and 2019. It didn't say which the companies were. By the way, I think one reason for that is because I think that list includes Bank of America, which, along with other banks, have paid out nearly $250 billion, so $247 billion in fines since the financial crisis. So again, kind of a sophisticated statement of the obvious, but companies that sort of do good work on E and S and G appear to perform well. All right, here's another one. I often get asked, well, why is that? Like, why do people care so much about diversity if you just care about financial performance? And the answer is because it really helps you to become more profitable. And this is some amazing data that's been pulled together by McKinsey with 900 plus kind of different underlying company examples. And if you have a sort of, if you're on the top diversity quartile, you will outperform your industry, or your probability of outperforming your industry, probability of outperforming the bottom quartile is 36%. So that's a really meaningful difference. Okay, so what is it about a sort of diverse group of employees that makes for sort of higher profitability? And the answer is diverse teams, they tend to focus more on facts, they process those facts more carefully, and they are more innovative. Now, here's the big disconnect. If it's so great for business, we would in theory be good at stamping out prejudice. No, wrong, unfortunately. And you can see here some data about the sort of black professionals who say they've experienced prejudice at work in different parts of this country. So a lot of work still to do. Who's investing? That's, we covered the performance side of things. We also need investors to sort of, make it worthwhile for the investment industry to produce funds and set up funds that people could then eventually come along and buy. And the answer is we're seeing a lot of interest, So this is, again, data from Bank of America. These, not that surprisingly, are the sort of the specific groups that are either owning or have an interest in owning ESG funds over the next 20 years. 20 trillion, that's nearly as much as the market capitalization of the S&P 500. This is a great chart. This is one of my favorite charts. So what this is showing you here is inflows. So, people deciding to move money from somewhere else in their portfolio into ESG funds over the last 10 years. And look at the last couple of years. Can you see my cursor up here? 2020 up to the first half. So the first 6 months of 2020 has taken in as much money as 2019, which itself smashed the prior record of 2018, which smashed the prior record for 2017. So And by the way, that was in the middle of the most unbelievably vicious, even though very brief, bear market that was triggered by the pandemic. So, I mean, if this is kind of, in my opinion, a really big kind of green flag for the overall sector, and I think you'll see investment firms starting to put out much better, more sophisticated, and much more ESG and sustainable funds of different kinds. Okay, so we've done the fact that performance is good. We've seen that investor interest is really strong. So we're now going to turn to some examples. What does sustainable investing kind of look like in practice? So I'm going to split this into two buckets. So private markets investing and public markets investing. So listed companies basically versus smaller usually and unlisted companies which are privately owned and you can't go onto the stock market and buy shares of those companies. So usually private markets investors are in earlier stage, younger companies, often with unproven technology. And then once the technology gets proven and they sort of generate some revenues and customers and so on, then eventually they go and do a public offering and they go to the New York Stock Exchange and ring the bell. And then they become a public company. That's sort of the summarized version of what happens. But here are some really cool examples. One of my favorite is Zipline. So this is a company that was funded by my old employer. It does drone-based blood and drug delivery in Rwanda. Rwanda is a super mountainous country. It's not that big, but the roads are terrible. And they often get washed out in the rain. It might take 5 hours for someone to drive at sort of, 30 kilometers an hour from the capital out to a village to deliver some drug or some blood or medication. And by that stage, it could be too late. Zipline has got something like 80 or 85% of the population of Rwanda within half an hour. Isn't that cool? Give me a thumbs up if you think that's cool. I mean, I think that's just amazingly cool. And these drones will fly at 80 miles an hour over the mountains, drop the blood on a little parachute, and it will just land in a drop zone near the village on the soccer field or whatever, and then the local nurse can pick it up and figure out what to do with it. But I mean, incredible company, and they figured out a way of keeping all the stuff cold, which in Rwanda, as you can imagine, is not always that easy. All right, and here's some other examples. So, coding school in Latin America, Dreambox is using cool technology to sort of personalize the math tuition for school-age kids. They figure out what you're good at, what you can't, what you haven't quite mastered, and they just adapt constantly the questions that you're asked to make sure that you're progressing sort of as efficiently as you possibly can. And this is really cool. I mean, most of us were in school, and at least in my case, either you had no idea what the hell the teacher was talking about, or you were kind of bored the number of minutes in any given class where you were kind of right at the sort of frontier of your capabilities. In my experience, ended up being not that many, but maybe you guys had sort of very gifted teachers who could kind of keep you right on the knife edge of sort of knowing and not knowing, which is sort of how you get smarter. Okay, so that's the private markets. Let's turn to the public markets. The public markets are the ones that you see in the newspapers, the S&P 500, the Dow Jones. These are the big famous companies like Microsoft and Apple and General Motors and Ford, which we can all buy shares in if we want to, and which most of our pension money is invested in mutual funds. And here is a cool innovation which shows what can happen if you have enough investors who are interested in investing in ESG related products. And this is a variation of the S&P 500. The S&P 500 is the 500 most valuable companies in the US, roughly speaking. And they've just made an ESG version of that by going through these steps to keep it very simple. Step one, they basically say if you're involved in tobacco or controversial weapons or the UN Global Compact gives you a low score, you're out. Step two, we have our own ESG scores. And if you're in the bottom 25% in your industry group, that's what GICS means, it's Global Industry Classification Standard, you're out. And then you basically kind of work your way down and then until you hit sort of 75%, and of your particular kind of bucket. So let's say it's airlines or transportation or whatever, like mining or software or whatever it is, and then make the index that way. So pretty cool, right? You are penalizing companies that don't do a good job on ESG. But you're penalizing them because there's a whole group of investors who basically said, we're not interested in buying your stock. And that, by definition, keeps the price of the stock lower than where it would otherwise be. Okay, next one, carbon efficient indices. So here they basically bump up the share you have in the index if you are very transparent, and they give you even more share if you have a business model which is moving quickly towards low carbon alternatives. Again, by sort of messing around a little bit with the shares, the slice of the index that your company represents, and making it bigger if you're being a good citizen in terms of carbon, you will have a lot more investors buying your stock, and that pushes your stock price up, and that obviously incentivizes good behavior. Okay, so that's that. In terms of the sort of the development of the market, there's a lot going on. It's all, I think, basically pretty positive. Companies which are doing a bad job on ESG are getting excluded from these indexes, and companies which are doing a good job of being included, and their stock prices are moving either up or down accordingly. So we're at the last section now. What can you do to take action? So first of all, understand where is your money. This is often a job which a lot of people dislike. They dislike logging in, finding their login. The website's often not that user friendly. You need to sometimes call somebody. It's just a sort of friction, and you never get around to it because we're all super busy. Just make a deal with yourself that you're going to do this, and understand where your money is and how it's invested. And if you're in a defined benefit plan, which a lot of the IATSE folks are, you can ask them to include more sustainable investments in the way that money is invested. You can't influence that directly, like you can't choose yourself, right? I want that fund and not that fund. You have to do that as a group. But if as a group you collectively decide, you can make a pretty big change. So do that. Think about doing that. And if your savings are connected to you directly, so you have a 401k as opposed to a regular pension or an old-fashioned pension, then look at the options that are on the menu. You may have the opportunity to invest outside the menu, lobby to have the menu changed if you don't like what's on the menu. And here are some examples of ETFs which are broadly ESG aligned, or in some cases they are even impact oriented. So they are focused on specific UN Sustainable Development Goals. So here's one which is SDG, which is run by my cursor's disappeared. Where's it gone? Run by BlackRock. All right, and then there's another sort of flavor of ETF you can take a look at, which are ones which invest in a particular kind of technology or a particular sector. So there's one which is invest just in the wind industry, which has been growing like crazy, as you can imagine, as the world decarbonizes. And they often have tickers like this where there's a little cute joke in them. So this one here is FAN. Because of the wind sort of connotation. So this is about as amusing as our jokes get in the financial services industry, and I wish things were different on that front. I really do. Okay, there we go. I think I'm now on slide 27, and that's my first attempt at humor. I really do actually feel bad about that. I wish I'd sort of maybe worked in a bit more exciting material earlier on. Okay, and then so do your research. Think about how much risk you might want to take. Which, on the whole, you can often stay within the broad parameters of what you would have done anyway. But you can kind of angle your investments towards things which are sort of ESG oriented in different ways. Okay, here are some resources. You can call up your plan administrator. I even did you the service of writing down their number because I was on their website already. So if you're in IATSE, here it is. Write it down. Maybe we can make these slides available to the folks on this webinar, and so you can call them up and just find out what is in the other bucket. I wasn't able to do that for you. What stocks portfolio, what stocks are held in the stocks part of the portfolio, and so on. Morningstar.com is a great resource. A lot of the content is free. For about $120 a year, you get access to a lot more content, including a lot of written sort of commentary that's written by a human. At PIMCO, I actually dealt with Morningstar a lot, and I have a very high opinion of that organization. Number three, you can get a lot of resources from the ETF providers. So BlackRock runs iShares, Vanguard runs their own ETFs. These are enormous organizations, you know, $5, $6, $7 trillion they manage in each case, and they have a lot of resources. I'm a big fan of Ron Lieber. He writes in the New York Times. He writes a column called Your Money, which is a personal finance column, and he's won 3 Gerald Loeb Awards, which are awards for kind of business, finance, and journalism. And then if you want to kind of dig into it some more, I'm also a big fan of these massive open online course platforms, or MOOCs, which are offered by Coursera or edX. And in many cases, you can get access to truly world-class instructors and truly world-class institutions. So Robert Shiller is an example. He's a Nobel Prize winner who's based at Yale. And he has a course which thousands of people have taken on which are called like the global financial markets. And then there's another one there called personal and financial planning, which also gets very good reviews. Okay, some closing thoughts. So sometimes this stuff can feel overwhelming, but I truly believe that investment activism is one of the most important things you can do. You know, people really are incentivized by money, or so it would appear as I look around the world. And you deciding that you don't want to hold this fund, but you do want to hold that fund, you may feel like the number of dollars that you, in play may not, you know, seem all that consequential next to the S&P 500. But if you care about it, I would encourage you to sort of take action with those investments, because once you've done it, you then go, you know, go on with your life, and every day, you know, an ESG-oriented fund is penalizing bad ESG actors and rewarding good ESG actors. So it's kind of literally you're taking climate activism in your sleep. So that's the first thing I'd say. And I'd also say we're all a team in this. We're all trying to make the world a better place, as far as I can tell. You know, you as members of the sort of the theatre profession bring extraordinary scarce talent to this problem around advocacy, around storytelling, around changing hearts and minds. This is not a talent that I particularly have. I think if you read my little bio blurb, I was on the same stage as Tom Hiddleston, who's gone on to do great things. And as I mentioned, I went to go and study accounting and business. But you know, I would just encourage you to use the talents that you have to sort of tell the climate story. And I know that just by being members of Broadway Green, you're doing that already. You know, major on where you really have talent, but think about every action. We all, you know, every decision is a climate decision in one way or another. Investing is one of them. I think it's an important one. It's an important group of decisions. But I'd just encourage you, as members of the sort of pro-climate reality team, to think about all your decisions in the context of being climate decisions. And so with that, let me just move to the last two slides, which in some respects break my heart, but also energize me at the same time. So the first is on the S of ESG, on social. You know, there's been a lot of discussion, appropriate discussion about systemic and structural racism in this country. And this chart is a very powerful illustration of that. So you've got 13% of the population are Black, only 10% of college degree holders are Black, and only 0.8% of Fortune 500 CEOs are Black. That, by the way, you know, is exactly 4 people. So 0.8% of 500 is 4 Black CEOs. So something is going on between having 10% of college degree holders being Black and only 0.8% or 4 people becoming Fortune 500 CEOs. And you know, the whole private sector and society more generally obviously needs to work really hard on making those numbers make more sense. On the right here, you can see diversity and inclusion. with kind of basically black professionals saying that, only 13% of the time are the diversity inclusion efforts at my company effective. So that is, again, something which you can try and make a bit of a dent towards by, rewarding companies with your investment dollars that are working on that. And then this one is a kind of planet-wide. This is maybe the most important slide that I'll show you. This is the planet-wide carbon situation that we're in. So on the 1st of January 2018, to have a 67% probability of staying under 1.5 degrees, we had a carbon budget of 420 gigatons. So a gigaton is a billion metric tons. A metric ton is 1,000 kilos. A US ton is about 900 kilos. That's the budget. That's what we had left on the 1st of January 2018. And every year, the planet, mankind, produces about 42, 43 gigatons of carbon. And that hasn't changed. So in 2018, we produced 43. In 2019, we produced just over 43. And in 2020, it's going to be slightly less because coronavirus has slowed things down a bit. But we're still going to produce over 40. So by the end of this year, when we watch the ball come down in Times Square, we will have 293 gigatons of carbon left to have a 67% chance of staying under 1.5 degrees of warming. And at this rate, at 42-ish gigatons a year, we'll be done by Thanksgiving of 2027. So maybe I'll just give you another couple seconds on that slide. It's truly sobering. And the vast majority of this is obviously burning fossil fuels, right? So 37 out of the 43 roughly is burning fossil fuels, coal-fired power plants, our cars, that kind of stuff. And then other human activity is livestock and deforestation and land use changes and that kind of stuff. But this is my closing call to action. Please share your questions or feedback with me. There's my email address. And again, thank you very much for joining me this afternoon.
Thank you so much, Charles, for that incredible presentation. I certainly just learned a whole lot. And so I know I'm absorbing it, but I would love to open the floor now to questions or thoughts from all of you. I certainly have a list. Charles, when you're ready, if you want to share your screen after everyone gets your email address down, that way we can be in conversation with each other.
Sure.
Great. Yeah, Charlie.
Can we get copies of that presentation? Two, was there error and I overlooked it? And if not, can we get? Do you have some sort of guide or list of alternate ESG funds that we could consider?
Okay.
Is there ratings of them, lists by sectors, etc.?
Yeah, great question. Let me just write this down. So on the can you get the presentation? I'd say yes, please. I can circulate a copy to Molly and Christy, and yes, they'll figure out a way of getting it to you. And then in terms of the funds ratings, I'm pretty sure Morningstar has got some, because Morningstar just bought Sustainalytics, but I'll have to dig into sort of what their exact offering is on that front. Overall, as an industry, though, I think the rating of the actual mutual funds or ETFs sort of ESG quality is some way behind the efforts to rate the underlying operating company, right? So there is a relatively well-developed point of view about, is Apple, how does Apple score in terms of ESG? And it does pretty well. There's less, I think, so far research on how does the Vanguard XYZ ETF do in terms of ESG. But you can go on the Vanguard website and they do have plenty of ESG product, but I haven't seen as much, to your question, sort of independent rating of that product.
Yeah. So just in terms of making this actionable, so I've been over the years on a bunch of committees deciding what funds various pension plans and other things invest in. If I want to do this, I'd love to be able to have some ideas about which to look at. I've never liked BlackRock, particularly as an organization, though they have the funds. But and if someone is going, we have somebody who is on who participates on equity in equity. What actionable steps, other than saying, hey, you people who know a lot about this, give us some alternatives? What are the best tools to being actually able to get to the point where we're getting, I could pick alternatives for some things I'm involved in right today if I had a good way of choosing them.
Right, I see. Yeah, it's a good question. I mean, I think my approach has been essentially to form my own judgment based on materials supplied by the fund company. But your point, and I have been in separate conversations with one of the sort of the data suppliers about what a mutual fund rating system might look like. But it's still quite early stage. If you're on a committee that is allocating defined benefit money, so the big $500 million pot of IATSE, for example, then I would push your consultant, the consultant that's advising you, to kind of justify their choices. Those would be my sort of next actions.
Okay, thank you.
Bridget.
I might be the only one on this call who's an IATSE Local 1 member who actually can benefit from all that information that you gave us about Local 1. I will say something interesting has happened recently, which is our retirement funds, or Mass Mutual has just been acquired by Empower, which I got an email about recently. So I don't know how that's going to translate, but it does mean to me like perhaps there is like changing, like an opportunity here where funds might be managed in a different way. I have like via non-ESG specific or like related issues, had a conversation with Mass Mutual representatives just to inquire regarding like my financial advisor saying, like, what's the deal with these funds? Who's picking them? And so they were like, your trustee, like this is chosen by your trustees. But yeah, you're right. Like there is a consultant who is saying, okay, these 30% of your index fund, which is like through Mass Mutual, not specifically customizable. There's like there were like not very many options. It's going to be like high expense ratio bonds, essentially. And so hopefully this will provide an opportunity. But as Charlie was saying, like I would love to, I guess what you're saying is in order to take some sort of action I'm not on the committee, right? I'm a member. Do I, at this moment when we're potentially changing, have a conversation with our trustees who might be the people who are involved in that conversation and say, hey, what's the like, does Empower offer ESG funds? And like, what are, like, can we push them to incorporate that more, because I think a lot of people don't really, I think a lot of people take the default and don't, and even the trustees might or might not be aware of the ESG option. So is that like the best actionable thing we can do?
Yeah, I think it is. I think contacting the trustees, and you know, and if you can kind of team up with other members of the plan. I mean, there are only a couple thousand of you, I think, to sort of, you know, lobby for some. You can do a couple of things. You can do, you know, the most extreme / also effective thing would be to include ESG stuff in the default and have people opt out of it if they don't want it. But if people are uncomfortable doing that for whatever reason, then make sure that you've got, you know, you can have the sort of broad stock market fund, and then have the kind of the cousin of that, which is the ESG version. And frankly, the performance between the two, because of the way these indexes have been designed, shouldn't be that different. In some cases, it will probably be better, actually. In fact, most of the time, in from what I've been able to see recently.
Thanks, Charles. Marjorie.
Hi, so I have a couple of questions and comments. I know with Actors Equity, we have looked into and are trying to be better. We specifically looked into the fossil fuel, our investments in fossil fuel recently, and we were pretty good. We were down there. But am I correct in the trick is sometimes that if you're invested in a mutual fund, sometimes one of the bad guys sneaks in there, even though you're thinking that you're investing in an ESG style mutual fund, that that there are mutual funds that a fossil fuel will, or a tobacco, or a thing will be part of that fund, even though they have other good things. Am I correct?
Yeah, I think, yes, that's right. I mean, a mutual fund could hold, depending on what exactly you're getting, but if you're getting a fund that's like a global stock fund, it could hold, you know, thousands of companies, or the shares of thousands of companies in its portfolio. And yes, you know, unless you specifically say that the fund is not allowed to hold tobacco, or, you know, making controversial weapons, or gambling, or whatever. But I think most importantly, you may want to have a carbon exclusion of some description. Then yes, it'll most likely hold a very similar percentage in its portfolio to what the index holds. So the trick, I think, is to find funds which have been indexed against these S&P 500 low carbon indexes, or the sort of ESG index.
And the other, so just so anybody else on the line knows, that Equity is trying to be part of it in and pay attention to that. The Equity Union doesn't hold the fund, so it gets a little bit tricky in how we then present that. And I'm not sure if it's the same with IA. We can ask them to do stuff, but the fund is our pension and health fund funds are held in a separate entity for us. And our pension plan, our health plan is obviously a big mess, but our pension plan is really in good shape. And we're trying to make sure it's better, sustainable funds. Now, on a personal level, and part of what Charlie was asking, how do we tell our personal investor what we want to buy?
Your personal financial advisor, you mean?
Yeah.
Yeah. Well, I think they have access to tools. They have access to, I think Sustainalytics has an offering. I don't know as much about that space as I should, for sure. And I'd love to follow up with you and Charlie. Charlie, great name, by the way. It's always great to meet another Charles. But about the tools that they would use. But either MSCI or Sustainalytics does offer some sort of rating system for mutual funds. But I think, what I have observed is for anything that's in your portfolio right now, so let's say you hold, an S&P 500 ETF that's run by BlackRock, you will most likely be able to find an ESG version of that mirrors the volatility and performance profile of the main ETF quite closely. And so the first easy step that you can take is to look across your whole portfolio and say, okay, I don't want to hold that one. I want to hold the ESG cousin of each thing that I own. And then but the market is changing very quickly, and things are moving all the time. So for reasons that I think were clear in the presentation, just in terms of the asset flows have suddenly gotten enormous.
Yeah.
Thank you. I'm aware of the time, and Paige has one question. Sorry, Charlie.
Yeah, go ahead.
Has a question.
Paige.
Thank you.
Hi. This might be a more complicated answer than we have time for. But could you talk just a little bit more about like private market investing? Because I've been a little interested in investing in smaller companies that are doing good work. Like I said, I don't know much about investing, but even just some advice on how to get started on that would be great. Thanks.
Okay. So there are a few different options, just real quick, and I know we all want to get out of here on time. There are angel groups, so you can find angel groups in, I don't know what area of the country. I guess it's probably in the East Coast, but there are angel groups that are around, and you can kind of look for those. There are if you have depending on your circumstances, if you meet certain kind of criteria around income and household net worth, you become I can't remember the exact term, or something like a kind of qualified purchaser, I think it is.
Accredited investor.
Accredited investor, that's right, exactly. Yeah, I should know that. And then that allows you to participate in certain private markets investments, which will often be distributed by a Morgan Stanley or a UBS or a Wells Fargo or one of the sort of financial advisor networks. And so that's another way to go. So those would be just two quick ideas, but happy to continue offline if you like.
Thank you.
Great, thank you so much. Yep, I'd say if people have more questions, we will be sending out this deck. Thank you so much for offering to share that, Charles, in our follow-up email. Chrissy will be in touch tomorrow with all of that, and we'll include Charles's email address. So if you have more questions and want to follow up, you can be in touch that way. So a big thank you to you, Charles, for spending this hour with us, sharing your incredible expertise and answering these questions. I know we all learned so much, and I know I'm personally excited to get to work and go find all those logins and dig into making some changes and making a real impact. And I was completely remiss at the beginning to embarrassing Marjorie with a big old happy birthday. So happy birthday, jazz hands, since we can't sing in unison.
Thank you.
Happy birthday, Marjorie. And please join us next week. We will not be holding a green quarantine at our usual time, because on Monday, we have our Lights Up on Voter Mobilization Town Hall. Join us through our website or via playbill.com at 8 p.m. Eastern for an incredible slate of Broadway talent, and my goodness, I think we're up to a dozen incredible mobilizers from the voting and environmental community to teach us how to mobilize our voters, research down ballot candidates' positions, and so much more. So join us on Monday. And then the following week, we'll be back with a green quarantine session hosted by Lauren Patton and an incredible panelist of global youth activists So I look forward to seeing all of you then. Again, a big thank you to you, Charles, and all of you for joining us. And we'll see you next week on Monday.
Thanks very much. Appreciate
Thanks,
it.
Charles. Bye, everyone.
Bye.